In this video, we will talk about the company called STEM and its incoming merger with Stpk. What is the current price action dynamics, why the price has increased by so much, and my recommendations on if you should buy it. So STEM is a renewable energy startup that uses the power of AI for both production and distribution. Instead of using the conventional model of producing the electricity in one place and then distributing it through one single system, STEM uses AI to distribute and produce energy in different locations and distribute them to the clients with the best route possible. So what they're basically saying is that they want to use an algorithm to distribute and to produce kilowatts from power grids that are most likely going to be solar panels via the most efficient way possible. This is their argument and their value proposal. So ever since the merger was announced with Stpk, the stock price went from $10 to $46.40 as of the recording of this video, which corresponds to an increase of 364%. For a period covering November 2020 to February 2021. This is a massive increase, of course, even by 2020 standards. We don't have much financial statement information as of yet because the company has just announced its intention to go public. However, it is announcing that in 2021, the company is predicting a revenue of $147 million, which is very significant for any startup. And their current market cap is $2.22 billion. This, in my opinion, is one of the reasons why the price has increased so much. Because when we look at similar companies that even though they're not the exact same thing, they're not in the same position, but they are in the same sector, and maybe just a bit more mature, we can see that, for example, First Solar has a market cap of $9.64 billion, and SunPower has a market cap of $6.43 billion. So people think, well, look, this is a startup, right? They are going to grow in the future, and they still have a lot of room to grow, simply because their valuation is still comparatively low to what the company could be. Now, keep in mind that this is not the same company as First Solar or SunPower, so it's not going to be exactly like this. But it is safe to assume that they can still grow to maybe $3 or $4 billion of valuation. This is not impossible to think of. Now, let's take a look at institutional investors, because this is also a key element, in my opinion, to understand why people decided to go in, and it is a very promising company. Now, let's take a look at the institutional investors. When we look at the people who own Stpk as we speak, we can see that 73% of the shares are currently owned by institutional investors. What this means is that as soon as the SPAC went public, they probably felt that something is going on, something very promising is going on with Stpk. So either because they know the CEO or the chairman, or because they know the team. This is possibly why we can see that ever since Q4 of 2020, many of those companies began to own shares in Stpk. And what we can learn from this is that going forward, I would say that it's reasonable to keep following this team the same way that some people follow Bill Ackman or Peter Thiel. Just the clout of those investors sometimes is enough to attract a mass number of investors who want to buy the shares of those companies, because they assume that they know what they're doing, that they're good at zeroing in a very promising target, and so on. So they may be right, they may be wrong. But as far as supply and demand in the financial market is concerned, this is a very useful information to have. The organization behind the SPAC is called Triangle Peak Partner, TPP. And going forward, I believe that it would be interesting to keep following this company to see which SPAC they also plan to take public with. One very important factor when looking at the SPACs is the sector, the companies they plan to merge with. And in the case of TPP, it seems like it's mostly going to be renewable energy. One of the reasons why Tesla is so attractive to investors is not because it manufactures cars. Because otherwise, it would be reasonable to question why Tesla is valued that much, given that it doesn't produce nearly as many vehicles compared to other groups. It's because Tesla is often perceived as an energy company. They are in the business of producing, storing, transforming energies, and cars may just be one of the many ways that this transformation happens. So when we look at STEM and the fact that they are going to use algorithms to distribute and to produce energy, this can be at the very least a powerful narrative for investors, because this is likely going to be the trend for the entire sector in the decades to come. By the way, this is unrelated, but I feel like it's kind of necessary to still say it. When I saw the business model of STEM, the first thing that popped up in my mind, funny enough, was Enron. Enron, for people who don't know, was this massive corporation that eventually was discovered that they were cooking their books and went bankrupt. But an interesting aspect was, back in the years when they were still operational, they were playing around with the power grids and where they want to drive the electricity to. So back in those years, there were worsening blackouts in California, not because there was not enough electricity, but more because people at Enron felt like they can drive the electricity to the locations that are the most lucrative. In other words, in places that charged less per kilowatt, they were willing to just let them not having any electricity. This, of course, was highly unethical, and I am sure that STEM refrained from doing this. However, we have to remember that an algorithm is just that. It's a bunch of zeros and ones that aims to accomplish a mission. So if you tell the algorithm your mission is to distribute the energy as equally, as fairly, as cheaply as possible to your customers, then it will do that. However, let's imagine in a scenario when years down the road, at some point, STEM is having very intense competition and it wants to boost its profitability. Is there a possibility that the board wants to tell the algorithm, you know what, we want to maximize our income? And then STEM goes ahead and says, okay, sure, perfect. I know where are the neighborhoods that pay electricity the most. I'm going to supply them first. Because an algorithm has the advantage of, first of all, working 24/7 and arguably at a lower cost. But it doesn't mean that its decisions are going to benefit everyone at the same rate either. This very much depends on the objective that is given to this algorithm. I would say that the AI called Athena is going to make or break STEM in the years to come. If it's used in an ethical way, it definitely has a lot of room to grow. But if it is used in an unethical way to jack up the short-term bonus of that senior management, then we may be having another scandal coming down the pipe, just like the one of Enron. Alright, so before we move on to my recommendations, if you like my videos, please like, comment, and subscribe to my channel, and please check out my page for more stock analysis videos. My recommendation is to buy the stock. I believe that given current valuation, given the current hype around new energy, it is more possible than not that this company will keep growing in, at the very least, the upcoming weeks to come. Given that the company seems to have quite a mature business plan and does predict that it's going to have revenue in 2021, it would be interesting to see how things are going to pan out. So for that reason, I would suggest to hold at least 50% of your position for at least 6 months, just to see if the company actually has the capacity to generate revenue. If it does, then every single quarterly revenue report may also become new catalysts to push the stock higher. Because the company is still a startup, I would recommend a maximum exposure of 2% of your portfolio. Thank you for watching. If you like my content, please like, comment, and subscribe.